If you've been keeping an eye on the economic news lately, you've probably heard all the chatter. Inflation, jobs, the Federal Reserve. It can all feel a little abstract. But right now, all that talk is creating a very real and potentially very big opportunity for homeowners. So let's dive in and break down what's really going on and what it could mean for your mortgage.
This right here, is exactly why we're talking about this today, 6.35%. Now, I know it might not look like some huge, flashy number at first glance, but trust me, in the world of mortgages, a number like this is a very big deal.
And here's why it's such a big deal. We haven't seen average rates dip this low in almost a full year. This drop has basically cracked open a window for potential savings that, let's be honest, a lot of homeowners thought was slammed shut for good. So the real question is, how do you know if you should climb through it? All right, so here's our game plan to figure that out. First, we'll tackle the big picture. Why now? Then we'll zoom in on you with a personal checklist to see if this even makes sense for your situation. After that, we'll get into the nitty-gritty, weighing the costs versus the savings, looking at the risks, and then we'll wrap it all up with a clear, smart action plan. Let's get to it. Okay, so first things first, why are rates dropping all of a sudden? Well, it all starts with some pretty strong signals coming from the very top of our economy, specifically from the Federal Reserve. Think of it like a series of dominoes. First, we've started to see some weaker job data. Then we're seeing signs that inflation, finally, is starting to cool off. And because of those first two dominoes, a lot of analysts are now betting that the Fed is getting ready to start cutting its key interest rate later this year. And here's the part that really matters for your mortgage. The market doesn't actually wait for the Fed to make a move. Just the expectation of rate cuts is enough to cause a huge ripple effect. Investors start snapping up government bonds, treasuries, which pushes down their yield. And since mortgage rates are super closely tied to those treasury yields, well, they get pulled down right along with them. That's the chain reaction we're seeing play out right now. Okay, so that's the 30,000-foot view. That's the why. Now let's bring this down from the big, complex economy right down to your kitchen table. It's time to turn the focus from the Fed to you. This is it. This is the first and honestly the most important question you have to ask yourself. If you locked in your mortgage when rates were peaking, this new environment could be an absolute game changer. So go on, take a look at your current statement. What's your number? And when you put the numbers right next to each other, the potential here really jumps out at you. I mean, if your rate is sitting up there at 7% or maybe even higher, that gap between your rate and today's average, that can translate into some seriously substantial savings over the life of your loan. Okay, so the rate is the big one, for sure, but it's not the whole story. To get that amazing rate, lenders are going to want to see a few other things on your checklist. We're talking about a solid credit score, a good amount of equity built up in your home, and they'll also take a look at how much time you have left on your current loan. So let's say you're checking off the boxes on that list and you're thinking, hey, this might actually work for me. What's next? Well, now it's time to do the math. This is the critical step where we weigh the upfront costs against those long-term savings. Sometimes a picture just says it all. Looking at a chart like this, the difference can be pretty striking. That shorter bar isn't just a graphic on a screen. It represents real money, actual cash, back in your pocket every single month. But here's the catch, right? There's almost always a catch. Refinancing isn't free. You've got closing costs to think about, and that can include a whole list of things, like application fees, appraisal fees, and different charges from the lender and title company. These are the upfront fees you have to weigh against those monthly savings. And this brings us to one of the most important concepts you need to know, the break-even point. It sounds technical, but it's actually super simple. You just divide your total closing costs by how much you'll save each month. That number tells you exactly how many months it will take to pay yourself back for the refi. If you plan to stay in your home longer than that, boom, that's when you start pocketing pure savings. All right, we've talked a lot about the pros, but I want to be really clear. Refinancing is not a no-brainer for everyone. To make a truly smart decision, you have to look at the downsides too. So let's do a quick reality check. And paying attention to this is just as important as doing that break-even math. Look, holding off is absolutely the right call if your rate's already pretty low. The math just won't work in your favor. And this one is critical. If you think you might move in the next few years, you'll likely sell the house before you even hit that break-even point. That's just throwing money away. And finally, just remember what goes down can go back up. This market is unpredictable. Locking in a rate today is a calculated risk. Okay, we've covered a lot of ground. You see the economic wind shifting, you've got the personal checklist, you understand the risks. So if you're thinking this might be right for you, let's shift into our final section, a clear, empowering plan with steps you can take, like right now. Here it is, your 4-step action plan. Super simple. 1. Run the numbers. Hop online and use a refinance calculator to get a quick estimate. 2. Shop around. This is huge. Don't just take the first offer you get. Get quotes from at least 3 different lenders. 3. Check your credit. Pull your report, make sure there are no surprises. And 4. If you find a great deal, especially in a shaky market like this, ask about a rate lock. And this isn't a one-size-fits-all situation. Your local market matters a lot. For example, in high-cost areas like the Bay Area, where the loans themselves are much bigger, even a tiny dip in the interest rate can mean hundreds of dollars in savings every single month. The stakes and the potential rewards are just that much higher. So there you have it. We've laid out the big economic picture, the personal checklist, and the math behind it all. The market has presented a potential opportunity, and now you have the tools to analyze it. The only question left is the one you have to answer for yourself. What story will these numbers tell for you?